Hello, and thank you for joining us for our webinar today on startup fundraising. You are in for quite a treat. We have so much information to share with you and two amazing people to actually share that with you. My name is Teresa, and I am part of the marketing team here at Early Growth. And for those of you who aren't quite familiar with Early Growth, I'll take some time to just chat about it really quickly. Here you'll see a quote from our founder and CEO, David Ehrenberg, who started this company over 10 years because he was passionate about helping early stage startups get financially aligned. Early growth, what we do, so we're that in between outsource tool that you can use if you're not quite ready to hire a full time CFO. We have CFOs on our team that have years of experience. They've worked directly in house with startups, so they know everything about startups, what to do now, and how to take you to the next step. We offer financial and accounting services. We also offer tax services as well, and those 409A valuations when you're ready to do that. We also have fund accounting services to offer. So please connect with us after this webinar. You can reach us either at earlygrowthfinancialservices.com or earlygrowth.com actually, or you can check us out on YouTube, or you can contact us. There will be an email right at the end of this. Also, for all of those that are joining us today or registered today, just to let you know, this webinar will be available in 48 hours. You will be able to view it on our YouTube page. It'll also come to your inbox. So if you're not able to stay on the full time, don't worry, you'll get this and you'll be able to look back and listen to the conversation. So I'm going to share with you our presenters today, Ala and Sirk. They've been with Early Growth for quite some time. They are amazing, and they will be talking you through startup fundraising. So Ala, would you like to introduce yourself, and then Sirk, and we'll get started after that.
Sure. Thank you very much for the nice intro here. Yes, my name is Ala Ismail. I've been with Early Growth for a little over 10 years. Working in all sorts of industries, from e-commerce to hardware, software. I've kind of settled into a specialty right now in SaaS companies. It seems to be a bulk of my client base, but I've done all kinds of other industries as well. I've helped companies raise well over $150 million through my career at Early Growth, and also helped them in different stages of their growth and building the accounting team. Look forward to talking to you guys in greater depth later on.
Hi, everyone. My name is Sir Groh. I am also a consulting CFO with Early Growth Financial Services, and I have been with the firm for coming up on 7 years, I guess 6.5 years now. And like Ala, I've been lucky enough to be able to work with lots of startups in different industries, different phases of their growth, software companies, SaaS companies, hardware companies, some consumer products companies, as well as I actually have a couple of nonprofits as well. And like Ala, I've assisted companies grow. I've lost lots of companies through growth or acquisitions from bigger companies, and I'm excited to share some information with you today.
Awesome. Thanks so much. And just to let you guys know who are listening, feel free to ask questions throughout the webinar. Ala and Stirk will be able to answer those for you. You can put them in the chat box and we will read it. We will answer it. So don't worry. So without further ado, I'm going to get started. If you can just let me, I'm going to mute myself really quickly.
Okay, so let's go ahead and get started. But before we do, just kind of a word in front, which is that this is kind of a hefty presentation. There's lots of information here. It's kind of meant to be as an introduction to fundraising, we do actually go much more in depth into several of these categories in other presentations. So while we won't do a deep dive into anything in particular here, we encourage you to check out our YouTube page as well as our website for past presentations that we've done that will give you a lot more in-depth information on some of these topics. So you will notice that we'll kind of go through this slide set a little bit quickly here. So let's just talk about, first of all, the reasons why we want to fundraise. The main reason that we want to fundraise is to accelerate our growth, to expand our network, and from a timing perspective, right? And so, down here, you'll see there's a little note here that says not for product market validation. And the reason we say that is because really, we as founders should be doing some of the work on our own with our sweat equity, as well as some money that we're going to be, putting into the company ourselves as a way of kind of getting started with product development, some market validation, and to the extent that we can fund ourselves during the initial phases, that's really what we want to do. We want to fundraise externally to do these things, right? If there's some timing that we're trying to hit, the market is developing. We are one of the early players in the space, and we really want to attack a market. That's a great time. That's a great reason for fundraising. Same thing with obviously accelerating the growth, especially once we actually have product and market validation, to the extent that we need to have funds to hire the right people, acquire customers, and to perfect our product. Those are kind of the main reasons that we want to fundraise, at least in early stages. So let's move forward, and we'll talk a little bit about funding sources here. And here we have, thank you, Teresa. So this is just kind of like a little timeline, and obviously there's a lot of information here, but it kind of just gives you some general ideas of, when you would be raising different types of funds, right? So, at the ideation phase, you're going to be, bootstrapping it, meaning that you're self-funding it. You may be working on a product with a founder, not paying yourself very much money, and doing whatever you can to get the product going without external funds. You may at this time also get a little bit of money from friends and family. The next stage is kind of, when you now start to, look at outside investment. And here, we'll talk about angels and VCs in particular on this presentation. We'll touch upon, venture debt and when that makes sense, because we think that's a great tool to add to your arsenal of fundraising to be able to give you additional runway. We won't talk so much about later stages like strategic investors and banks. That's kind of, as you can see, that's kind of, usually for later stage companies after, we've kind of gone through initial rounds of fundraising. And then, we don't really touch upon crowdfunding here. Crowdfunding is a source of financing that makes sense for certain types of companies, not for all. But it is something that you want to be aware of depending on what kind of company you have. Okay, so friends and family, and this is kind of where you're not really going out to external investors. These are people that you know well, that know you, that want to see you be successful. They might have some money that they're able to invest in your company, and so you reach out to them for a little bit of assistance in early stages. And I would say the main thing here is that the last bullet point, which is that unlike investing in a public company, in most cases, investments in startups are either do or die, right? I mean, either you're going to make a good return on your money or you're going to lose 100% of it, right? It's not going to be a case where, you're investing in a public company and after you lose 10 or 20%, you might pull yourself out and still retain 80 or 90% of your money. So make sure that everyone understands, not that you even just say it, but make sure everyone understands that it really should be money that can be lost completely without it impacting your relationship with that family or friend member. At early stages, I think, the convertible debt is the way you're going to want to go with friends and family, as well as even with potential angel investors as well. Okay, so angel investors. So this is kind of now where we start to talk about external investors, right? So these are professional investors, both VCs and angels. And there's three basically types of angel investor in kind of, I guess, in order of size, and so we'll talk about those a little bit. But basically, the main difference, and we get this question a lot, the main difference between an angel investor and a VC is that angel investors are individuals or groups of individuals who are typically high net worth individuals. Maybe they've made money. Maybe they were a founder and had an exit and have a lot of money, and now they're trying to invest in smaller companies. But they're basically investing their own money, right? Or they may have a group of angel investors, like this angel network. And so it may be a group of individual angel investors who are grouping their money together to be able to make investments in early stage companies. And so you might talk with an angel investor who has who writes checks for $25,000 to $50,000, right? You might have super angels who are a little bit more savvy, a little bit more experienced, who write bigger checks depending again on the kind of funding requirement that you have. And then ultimately you also have bigger groups that kind of work almost as a consortium of investors that create networks, angel networks, so that when you are making a pitch to an angel within this network, you're basically making a pitch to the entire group of within this network. So it's really just kind of different levels and different sizes of investment that you're going to be looking at. And really from a fundraising perspective, I don't know that there's that much to say about, whether it makes sense to talk to one or others. I think it's usually depending on the level of fundraising that you're looking for. Okay, and then micro VCs is it's almost like a gateway between angel investors and traditional VCs, but they are basically just smaller VCs, and they make they have smaller funds, they write smaller checks than traditional VCs. They'll make investments in companies at early stages, maybe the seed stage or Series A, but they're usually not big enough to where you're going to be able to go back to them with multiple rounds of financing, with bigger rounds of financing needs at higher valuations. And so you just kind of have to keep that in mind. But having said that, one of the advantages of a micro VC versus a traditional VC is that because they're smaller, because they write smaller checks, they don't have nearly as much in terms of oversight that traditional VCs have. They tend to be a little bit more sympathetic to entrepreneurs and operators. They're not really hard over on making sure that you're hitting all the metrics and requirements and really staying on you on a month-to-month basis. And so it's for many early stage companies, micro VCs is a really, really good way to go. Okay, and then I know I've already talked a lot. I'll let take over and talk about funding vehicles.
Yeah, I'll talk just to kind of bridge a little bit to what Cirque has been saying. I think the takeaway from the different funding sources is that there's really no set rule. It used to be in days gone by that there were certain groups of angel investors, there were certain groups of later round investors, and things were very delineated. I think over the past few years, we've been finding that the different investors tend to take on different different stages. I've seen companies that are very firm VCs, companies that write big checks, or investors that write big checks, and clearly in the VC world, invest in angel rounds or in seed rounds. There are venture funds that used to invest in early stages that now invest in late stage companies. There are individuals who write big checks. We now see private equity and hedge funds playing in the startup world. So the old notion that VCs come at a certain stage and angels come in a certain stage, it's good to understand. However, at least in my recent experience, that those lines have been crossed, and it's getting a little bit hazy. Cirque, do you kind of get that as well?
Yeah, absolutely. That's exactly right, Ala. I think, as founders who are looking for investment from the outside, it really is, we need to kind of, we'll talk about kind of, how we plan and how we kind of determine how much we need to be raising a little bit later in the presentation. But it's really kind of, we need to kind of figure out, what are our goals and what kind of investor and what group of investors, makes the most sense for us, both from an operations perspective as well as a practical perspective, right? I mean, if we're not going to be going out to the guys who are writing 20 million and up checks, if we're looking to raise, if we're looking for a group of 3 or 4 or 5 investors for $3 to $5 million, right? And so, just doing a little bit of research, as you look at each of these groups, as you start looking at and honing the list of investors that you're going to be going after, and doing some research to figure out kind of where they fit and what kind of size checks and what rounds of financing that they invest in is that it's a little bit murky, as Ala said, and does require a little bit of work on our end.
That's great. So let's kind of talk about the different vehicles that once you've identified, a funding source, how do you, execute on that funding? And this addresses a question that was just posted on the chat line is, we'll talk about venture debt. And venture debt is really the best vehicle that I've found for very early stage funding. We talked a little bit about friends and family, and a venture debt is typically a note. It's structured in the same way as a lot of other debt would be. There's a formal agreement between you, the company, and the investor. And it's fairly simple. It's very, very quick. You close it quickly, and if, for example, if you're talking to friends and family, it's a way to execute on that and to formalize that agreement, and to get you into your company formation very, very quickly. The main feature of venture debt is typically it's either through banks or through financial institutions. So these venture debt holders, they will come in and kind of structure a runway for you. They capture interest on the debt that they give you. They also require, some of them will require interest to be prepaid in advance. Some of them require that the interest will be paid throughout the term of the venture debt. So a typical venture debt structure would be something like this. They'll give you, say, $1 million. The debt is unsecured. Let me go back. The debt would be sometimes secured by your intangibles, things like your patents, your any kind of whatever kind of assets that you may have, they may secure it, but in some cases it's unsecured. The typical venture debt will have a period that there's no interest, and the idea behind that is that they want the company to have a time to utilize the financing without the interest burden. So typically you'll have a year of runway where you do not have to pay that debt back. The interest accrues, but you do not have to pay that back. The primary benefit of venture debt is that there's no dilution, with the exception of warrants, which warrants are kind of like options that the venture debt holder would have. With the exception of those warrants, there is really no significant dilution. So a venture debt round will have an interest rate, will have a term, typically 3 or 4 years. They'll have a period where there's interest only. And then after that period, you'll start paying off the principal. So, venture debt is a great way for a company to kind of get going. Now, typically a venture debt piggybacks on a formal financing round. I've seen in certain cases where venture debt holders will come in and invest in a company without any kind of a formal VC financing. However, a lot of these venture debt lenders really rely on the due diligence that VCs have done or investors have done. That is also changing. A lot of the venture debt lenders out there have a fairly diligent or very strong diligence arm. So they do a lot of that investigation now, and it's becoming a much bigger field. So they're replacing the venture community in early stages in a lot of cases. But in the past, venture debt used to piggyback on formal financing rounds. Next slide, please. So the order that we had venture debt coming before traditional venture capital is perhaps a little bit backwards. Typically, you would go out and do your typical venture capital raise, and these are the VCs that you see at Sandhill. They usually write bigger checks. As I mentioned before, venture capital is not necessarily in A, B, and C rounds, but there are venture capital companies that participate in seed rounds, or what we used to call the angel stage. I've had companies that have fairly robust financing needs. There's a lot of capital equipment purchases and so on. So a lot of these VCs will participate in the seed rounds of financing, and I've seen companies raise as much as $8 million in seed rounds. So where these VCs will come in, there's typically a lot of diligence involved when you get into the venture capital. These folks are very savvy. So part of the things that you should be prepared for when you're raising a venture round is a great deal of diligence work. So there's a lot of red tape. Typically, when these venture capital investors come in, you will expect dilution. The dilution will be based on whatever kind of pre-money valuation. By pre-money valuation is the valuation negotiation that you will have with that venture capital company prior to you raising the money. And based on that valuation, you will figure out whatever dilution that will be created as a result of that venture raise. Now, the dilution that you could expect, it all depends on the risk profile. There are companies that I've worked with that have raised a significant amount of money that the founders have maintained majority stake in the company throughout the first couple of rounds of financing. And that is really the direct result of the founders being in a very, very strong position. There's a lot of competition from the venture capital world to invest. So as a result of that strong valuation, there wasn't significant dilution to the founders. I have also seen in a lot of cases that significant dilution, and that happens when the venture community feels that there's risk and that the founders could face a situation where they no longer have control and they get significantly diluted. So In a venture capital round, there are significantly more dilution than, say, a convertible note or friends and family rounds, where there's little to no dilution. You would expect in the venture capital round that the investor is a lot more involved. Depending on the round of financing and the amount of money that's raised, typically the lead investor will have a board seat. So they will participate in your board and they will have a lot more involvement. That involvement could be a very, very good thing. And, you know, we could get into the investor selection process, because a venture capital investor will be a great resource for your growth plan as well. It's not just an investor putting in money and then walking away. You'll find that the venture capital community has a lot of experience, a lot of contacts, and will be a great source for you in your go-to-market strategy, in your product development strategy, in your hiring strategy, and so on. So you can expect a lot more involvement in the venture capital phase. And then you would, with this increase in funding, you're going to have a lot more expectations. So be ready to perform, because these folks don't come in and give money just for the sake of. There's a lot of expectations of losses, but there's also expectations of companies getting results. And to the extent that these investors get majority of your or dilute you, and they're in the majority, I've seen situations where these venture capital folks just don't believe the idea and then shut things down. So plan the venture capital raise carefully, because it is the next level, and the next a lot more expectations will be reflected in that round. So we talked a little bit about convertible debt, and convertible debt is really the vehicle that a lot of, say, friends and family, and where you would get funding in the very earliest stages of your enterprise. Convertible debt is debt, but it's set up in a way that it will convert to equity. Convertible debt is great early on because it doesn't relate to it. It doesn't depend on valuation. So they're gonna, the folks giving you money early on, they don't have to argue with you about the value of your company in the early stages. And to the extent that you could develop value in that early stage, then that convertible debt holder will be able then to convert the money they gave you early on to a negotiated equity round with either an angel investor or a VC investor. So a convertible debt, some of the advantages and disadvantages. A convertible debt's biggest advantage is that it's quick. You could close it fairly quickly. It doesn't cost a lot of money, very little due diligence involved. Equity, there is a negotiation involved, because one of the key issues is the valuation of your company. And depending on where you are, that valuation can be very, very difficult. So equity involves dilution. So now you're going to be no longer be 100% owner of your company. You're going to dilute your holdings in the company a little bit. So there's a very careful negotiation that's involved. So really, the convertible debt is really meant for early stages or meant for bridging. So, for example, if you've just raised a seed round and you're running out of money, but things are going really well, and you're in the middle of raising your A round, you could potentially go into your existing investors or a new set of investors where you could get a convertible debt loan, and that debt will convert into the next round of equity. So that money essentially bridges you between your seed and A to B, and so on. We talked a little bit about venture debt. Venture debt is also used in that same vein. So venture debt sometimes will come in to bridge between rounds and give you a little bit more runway, so you could get the best valuation possible. So both convertible debt and venture debt is a great vehicle to kind of bridge between different equity rounds. We talked about the equity rounds, some of the advantages and disadvantages. Biggest advantages is a greater investor stake in your company, a lot more resources, and a lot more credibility. But with the disadvantage that comes with that is that you lose a little bit of control and the expectations are much higher.
I just wanted to touch upon one other thing about the convertible debt. I'm sorry, the venture debt in particular, and that is that because we've seen this happen where we get pulled into a company with, you know, maybe they've done a seed round of financing. They raised enough money for, you know, call it 15 to 18 months of runway to get the product development really up and going and to start customer acquisitions. And now they're like, you know, 8 or 9 months into that 15-month runway. And they call us in and they say, okay, can you help us, you know, kind of plan our next round of financing, as well as, you know, with operations and stuff like that. And then also the question comes up about venture debt. Well, at this stage, while it's great for us, while it would be awesome for us to, you know, when we have 6 months of runway, to go out and get a bank loan, or in terms of venture debt, you know, in most cases, it's already too late. Right, it's already too late because the guys who are typically doing these kinds of deals are, you know, as Ala mentioned in the venture debt slide, you know, a lot of them are basing their investment not necessarily on us as the company and entrepreneur, but on the group of investors who have already done their due diligence. Right, so that due diligence was done 9-12 months ago, and we also have less runway. And so now the risk profile has increased greatly from, you know, what it would have been like if we went to the bank 9 to 12 months ago when we just raised that seed round of financing. So, you know, it's, you know, while it's great for us, I think you're going to find that, you know, if we reach out to these venture debt guys a little bit late in the game, it's going to be the probability of closing a deal is going to be much smaller than if we would have reached out to them as we were closing the round of financing. So it's just something to keep in mind. We love venture debt, all the benefits of it, which is that, you know, the cost of money is cheap compared to equity. It increases our runway, it decreases our risk, it allows us to hit some of the milestones that we're trying to hit with this round of financing. So all of those things are great. Just make sure that, you know, that you're aware of kind of the timing elements of it, to take advantage of it.
That's a great point, Cirque. The one of the biggest challenges I have with my clients after they've raised a round of financing is I typically go in and tell them that this is the best time to come in and put in a venture debt line, which is counterintuitive for a lot of early founders, because they say, wait a minute, I just have a ton of cash that I just raised. Why do I need to get into a debt instrument right now? I don't need the money right now. And really, the reason I give back is that this is your best leverage in getting the funding in place right after your equity raise. Like Cirque said, it's cheap money, and it's cheap, especially in light of the bridging aspect of it. When you're ready to raise the next round, what you want to do to control dilution is negotiate the best terms possible, and the best valuation possible. And you don't want to do that with a decreasing cash balance hanging over your head. And if you have a venture debt line, you have that runway to go out and negotiate the best raise possible at the time. And when you look at it that way, you'll find that the venture debt line is really a great instrument to facilitate that greater dilution, because less dilution and greater valuation.
Right.
So the best time to do it is just after your equity raise.
And I think you're gonna find from a sizing perspective that in most cases it's not like you're going to be able to, you know, raise a, you know, $2 million venture debt deal on top of a $1 or $1.5 million equity deal. Right. So that's just not the way it works. Right. So what the venture debt is supposed to do is it's supposed to kind of help us to increase our runway by, you know, in most cases, like 3 to 6 months. right? But that 3 to 6 months could be huge for us, right? In terms of what we're able to do and the milestones that we're able to hit, before we go out for that second or third round of financing. And that's really what it's meant for. And so just kind of if we keep that in mind, and if we keep the timing in mind, then I think it puts us in a much better position to be successful from a milestone perspective, from a venture debt perspective, and equity perspective going forward.
Great.
Okay, so let's talk a little bit about funding strategy, and this is kind of where it starts getting, now we're talking about some of the things that we need to be thinking about. Not only just I need money, but why do I need money, and how much money do I need, and what am I going to be doing with that money? So let's go ahead to the next slide, Teresa. Okay, so the game plan really is contingent first and foremost on the first bullet point, which is milestone financing. We at Early Growth, we are huge believers in milestone financing, and what we mean by that is at an early stage, you're not going to raise enough money. If you're the kind of company, if you're a software company, if you're a tech company, and you're going to be, spending a lot of money to before we're earning profits, we're going to be raising multiple rounds of financing, and that's just the nature of the beast. Because first of all, no one's going to give us, $20 or $30 million on day one, and secondly, even if we could raise $20 or $30 million on day one, we'd be giving up, the vast majority of our company, right? Because the valuation isn't there. And so the idea is that we want to raise enough money in the seed round to enable us to use that money to make progress, to develop the product, to get the customer acquisitions, the revenue traction, whatever the milestones may be. We're using that to hit certain milestones. Because then if we're successful in hitting those milestones, when we go out for that next round of financing, we're doing it at a much higher valuation. We've taken risk out of the company, we've made progress, we've created more value in the company, and all those reasons cause the valuation of our company to be higher. And so then we're able to raise the next round of financing at a much higher valuation, raise more money, and give up less equity as we're doing so. And so the idea is, okay, the plan that we need to look at is, okay, what funds do I need? What are the milestones that I'm trying to hit in the next 9, 12, 15 months, maybe 18 months, right? And say, these are the resources that I need to hit these milestones. And if I'm successful in hitting these milestones, then I know I'm going to have a much higher valuation before I go out for that next round of financing. And so we kind of back off from that, right? We do the calculations based upon that. Let's say it's a number of eyeballs on our website. Let's say it's a number of customers. Let's say it's a certain amount of ARR for a SaaS company that we're trying to hit. Whatever those milestones are, we need to feel confident that we can hit it with the resources that we're going to need and the financing that we're going to be creating to get those resources, and that we feel confident that we're going to be able to hit those milestones. Right. And so that's really the first thing that we need to be thinking about. And then obviously, in terms of then you kind of back into how much money do we need to raise, right? What kind of people, how many people do we need to hire? How many engineers? How many sales and marketing people? How many admin people? What kind of contractors are we going to be using for professional services? Are we going to be doing some development overseas because that's a lot cheaper? Or do we really need to hire people locally? How much do we have to pay them? What kind of other infrastructure are we going to have to build up in order for us to be successful? And so all of that, it kind of builds up from a bottoms up perspective to figure out kind of how much money we need to raise. And then of course we have to kind of massage that into, first of all, from a practical perspective, are we going to be able to raise that amount of money? And, are we going to be able to claim a valuation where it makes sense? So again, it doesn't make sense for us to be raising a $5 million round of financing if we haven't done enough and the value of our company is only like $3 million, for example. Then we're basically giving up more than half of our company in the first round of financing, which is not going to put us as entrepreneurs and founders in good shape from an ownership perspective. Obviously, we highly recommend a fudge factor, right? Because we know that things don't always go according to plan. We use the word pivot a lot in startup world, which is that, as we're kind of, doing the product development, maybe the market fit isn't exactly what we thought it was going to be when we first started. Maybe we do need to do a pivot into a different, different product features and benefits. Maybe we go after a different market. So we should expect that we're going to be making some pivots along the way, and we need to factor that in when we figure out how to raise money. And again, kind of going back to this venture debt thing, right? This is where getting 3 to 6 months of additional runway on top of a financing is huge for us, right? Because it allows us that flexibility to be able to do a pivot and obviously spend a little bit more money while doing so, but still hit some of the milestones and targets that we're trying to hit. We already kind of touched upon what the money's going to be used for. In most cases, it's going to be hiring people. When I say most cases, I mean at early stages. In the first or second round of financing, it's going to be to hire people from a product development standpoint, as well as what do we need to spend money on to acquire customers, right? And so those are the two main things that we're going to be using the money for at early stages. And then we already kind of touched upon the costs and the terms and the conditions. All of that will kind of it almost like works itself out as you kind of go through the first couple of 2 or 3 bullet points in terms of what is it going to cost. If we're able to make the argument that we've got a huge market opportunity in front of us, we're the right people to go after it, and we got the right plan in place, and we just need some capital to get us there, then I think you're going to find that negotiation should go well for us. And then we already touched upon, where do we find that type of financing, whether it's friends and family at really, really early stages, whether it's angel investors at the seed round, maybe we've done enough and maybe we're even able to go after kind of VCs at a pure equity play in first round. But I think it we'll kind of figure out where that type of financing is going to come from, depending on what the needs are and what the opportunity is.
So, Sir, if we could go back to that last slide, there's I think an important. This game plan is so critical, and the way that you could visualize that game plan is to create a financial model or a financial forecast. Because that financial model will help you set the milestones. The first milestone financing point is so important. I don't know how many pitch decks that I've looked at from founders of companies where essentially their funding plan is we're going to do a $10 million seed round, we're going to do a $30 million A round, and then we're going to go do an IPO. And that is a recipe. That plan is a recipe for disaster. For if you're going in front of any kind of VCs, the minute they see that, they'll realize that you're a novice. That their vision of you is going to kind of diminish a little bit. So figuring out how much to raise and what that fudge factor, and by the way, on that chat comment, fudge factor is, the amount of money that you need plus some, because there will be pivots. And how do you know what that plus sum is without a proper forecast? And tie that into milestones that are digestible. Don't do we're going to go to market and then we're going to go IPO right afterwards. Be realistic in your game plan. Develop your product, whatever that is. Test your go-to-market strategy. Make sure that works. Grow your business, and those kind of milestones are a lot more realistic, and it will give you a lot more credibility in front of the in front of the investor world in general.
Yeah, absolutely. Okay, from a process standpoint, obviously, every situation is a little bit different. If you're a founder who's already been successful, if you've got a track record, if you have a network of VCs, who you can call, reach out to, and know that you're going to be received positively by that group. That looks very, very different from a first-time founder or entrepreneur who's looking for who doesn't have a network of VCs. I think for the purposes of this presentation, we're kind of assuming it's kind of the latter, right? I mean, if you've already had, if you've already done startups and if you've already gone through fundraising rounds and been successful, you're probably not, not spending a lot of time, on this presentation. But for somebody new, right, the key thing to keep in mind here is that fundraising ends up taking up a whole lot of bandwidth. Right, we like to say that it's a full-time job for one person of your founding team for at least 6 to 9 months. I mean, that's really the level of effort that's really required to do a full-on blitz of fundraising. So just keep that in mind, when you start the process. Don't expect that you're going to put together a pitch deck, send it out to a whole bunch of VCs or angel investors. You're going to get a huge amount of reception. You're going to make some pitches, and you're going to have 2 or 3 term sheets on your desk. In the first month or two. Assume that it's going to take a long time and plan on that. And the building of the value proposition, determining your funding round, we've already touched upon that. All is going to go a little bit more in detail in terms of actually pulling together a financial plan or a business plan in just a bit here. And then at this stage, I also do like to touch upon this last bullet point, which is that this is also the time, as you're kind of going through this fundraising round or planning for it, is you really need to think about the service providers that you're going to be working with, right? So there's going to be obviously employees, founders, product developers, sales and marketing folks, whatnot. But you're not going to be hiring, finance people. You're not going to be hiring an HR person, right? You're not going to be hiring a lawyer. And so, as you're talking to service providers that are going to be helping you, make sure that these are people and firms that are actually part of the ecosystem of working with early stage companies, right? So work with lawyers law firms who can assist you not only from a legalese perspective, but also who has a network of investors that they can reach out to on your behalf. Same thing with accounting and finance firms. And HR firms. Banks is a key one too. It's very easy for us to want to just open up a business account with Chase or with Wells Fargo, but they're not the best players in terms of networks with potential investors. And so seek out banks that might be able to assist you, not only from a banking perspective, but from potential introductions to investors. And then, we'll just touch upon, how you target VCs. These are some of the things that you want to focus on. Obviously, make sure that it's a VC that knows your space, that knows the industry that you're in, because they're obviously much more inclined to say yes to you, and they're also much more inclined to be able to assist you. As Ala mentioned, they're not just a checkbook, they're not just a pocket that you're taking money from. Right, the right VC is going to help us be successful in terms of introducing us to, partners, introducing us to potential customers, introducing us to, service providers. All of those things are going to help us be successful. And so just make sure that you're going after the right VCs. And so some of these things like maybe location is important, maybe it's not. Clearly, some level of expertise at the stage of the company that you're in and the industry that you're in is very, very important. Brand, may or may not be important. It's certainly not completely not important. How important it is, it kind of depends again on the kind of company, the industry that we're in. But that's kind of something for you to consider as you target the VCs. And then the last thing I'll just say is, do your research, right? Do your research. Don't just kind of blast your blast the pitch deck or executive summary to a whole bunch of VCs just because you know their name, right? Understand the kind of investments that they're making, understand the size of checks that they write, make sure that that's a fit with kind of what we're looking for. Do some research into their portfolio companies. They might already be invested in a company that is a direct competitor to us, right? And in which case, then they're probably not going to want to invest in the company, but they may be perfectly happy to see your pitch deck, to see how it might help their other portfolio company. And so just do some research before reaching out to VCs. And then, finally, obviously, the networking is key here. Most VCs, they get dozens, if not hundreds, of pitch decks, right? Every single week, right? And so they're not going to open up all of them. If it's a cold email or a cold reach out, in most cases, you're not going to hear back from them. Network to find, first of all, target the VCs or angel investors that you're going after. Then network to figure out, how to get warm introductions into those VCs. Obviously talking with other entrepreneurs. There's lots of, forums and groups out there where entrepreneurs are spending time together. Obviously, things like colos and incubators, right? It's a great place to hang out, initially when you're first getting started. It's cheap. It's a cheap way to get a desk and to also network with other founders as well as, potential investors, because investors are hanging out or spending time at incubators and colos as well. So I would just say that, you want to expand your network as broadly and as quickly as you can. Because you just never know who's going to make that perfect introduction to that perfect VC that you're targeting. Okay, I don't know, Ola, did you want to add anything to that? Or otherwise, we can talk. You can talk about what investors want to see.
The one item, Cirque, that comes out of your great discussion is really selecting the right. If you're fortunate enough to have the capability of selecting the investor, that is the best way to go. My son is now going through a college application process, and in that same advice I give to him, I give to investors. Not the strongest or the brand name venture capital companies may not be the best choice for you, even though they sound sexy. They might have invested in Google, but they might not be the best fit for you. So do that homework prior. In that same light, it's a little bit of reality check in the same way that I tell my son maybe Harvard is not the most optimistic version for you. If you're in a certain industry or a certain company, type of company that a Kleiner or Sequoia or those kind of companies don't invest in, don't necessarily try to fit your business model, whether it's maybe in a retail type product, to the venture capital firm that doesn't really invest in that area. So, being in a startup is not easy. It's not just a matter of just going to a VC firm and say, give me some money. There's a lot of groundwork that you have to do in advance to be successful. And maybe VCs are not the way to go to. Maybe it's better to do crowdfunding. Maybe it's better to go to Uncle Bill or Aunt Jane to get your initial funding, just because your idea is, kind of outside the realm of where some of these investors go to. So do that homework prior, I think, is the takeaway from what Cirque has just mentioned. So what do investors want to see once you've selected really your target investor profile? There are certain basics that they want to see. It's not as detailed as you might think. Next slide, please. So as Cirque mentioned, a lot of the venture capital angel investors or more institutional investors out there, they see pitches all the time. So you want to be able to have what we call an elevator pitch. An elevator pitch is a succinct statement, a short statement of no more than, say, 5-6 minutes that you could give to somebody about what your company does. So that is something that you should create early on, because you're going to get in these discussions all the time, whether it's through colleagues or friends or service providers or investors. Oh, what are you working on? And to be able to think through that elevator pitch, so it's not a different story every single time you talk to a different person. Creating that elevator pitch helps you solidify a lot of messages in your mind. The next level is really an executive summary. This would be something a little bit more detailed, 2 or 3 paragraphs of what your company does, what your advantages are, what your secret sauce, your go-to-market strategy, in a very succinct, who your team is, in a very succinct executive summary. And there's a lot of examples out there of what an executive summary would read, and to the extent that you could get help in executing in creating both an elevator pitch, executive summary, and a pitch deck will help a lot. But those, you'll definitely need that, because in the early introduction phase, you're not going to be able to send a whole pitch deck. A lot of times you might send just something through email, and an executive summary is a perfect vehicle to send a one-pager to a prospective investor. The next level is really a pitch deck, and we'll get into some of the elements of the pitch deck. But again, a pitch deck is not a manifesto or a dissertation. It should be clear, succinct, and address certain points, because remember, your pitch to a prospective investor will be limited to anywhere between a half hour to an hour at the most. And you don't want to have the potential investor read a lot of small print. So it has to have critical elements in the pitch deck that we'll go over some of them in the next slides. So here are the kind of the key elements that you should have in your pitch deck. Your kind of intro is really your mission and vision. It's kind of a summation of your elevator pitch. It's you being the visionary, telling somebody, this is what I'm going to be doing. A slide really to address the problem or a solution that your business is going to address. A slide that looks at the market opportunity. Tell the people out there that, hey, this is not just a great idea, but it's a marketable idea. It's an idea that's going to make us some money. What's your strategy? Do you have a specific goal in mind, your milestones? How are you going to approach this market opportunity, and how are you going to address these problems, and how is your solution going to help? So the market strategy is a key slide that you should have. And then finally, then the next is really your secret sauce. Here we say technology because we're technology focused, but it could be your product. It could be whatever it is that you're going to present, bring out to the business world. It could be your service, if you're a service company. Really your secret sauce, the product, and do that as succinctly as possible. Notice that all these are like one slide. The technology slide should be, maybe 2 or 3 slides at the very most, but to the extent that you could keep everything brief and succinct, the better. Also, talk about your competition. Do not come into a pitch and say, this is so great because there is no competition. There's always competition out there. So, make sure you address the competitive landscape. As we mentioned before, financials. And when we talk about financials, we're not talking about like a 5-6 slide presentation with detailed revenue model and so on. This is just a 1 or 2 slide showing really the financial landscape, something to show revenue growth, operating expense growth by general categories like sales and marketing, engineering, or product development, or operations, and general administrative type expenses, as well as related high-level balance sheet items, things like cash, accounts receivable, inventory, whatever really applies. And in this case, getting outside help in creating this slide by a financial professional will save you so much time, give you credibility. And I look at something like a SaaS company. You need to be able to talk to prospective investors and present your SaaS revenue model in a way that they're used to. So if you have an annual subscription of $12,000, that doesn't mean that your monthly revenue is $12,000 when you close it. Your monthly revenue is $1,000. So having a financial professional that helps you present your finance slide in a very clear, succinct way is really important and gives you a lot of credibility. Then finally, your funding requirements. This is what you're asking and what you're going to use the money for. That is a key slide. Don't be afraid to ask, because if you don't ask, you won't get. And every single prospective investor is going to want to see that. We talked about milestones, and this is your chance to tell the prospective investors, what are the different milestones or the key milestones that you're going to address. And then finally, your team. I don't know any investor that I've talked to about a company that I would like to present to them that their second question they've asked is, what's the team? Are they superstars? Are they investors besides the product, or in some cases, even prior to the product, they invest in the team. And if you have a good team behind you, even if this is your first venture, make sure you show it off, because that's really going to be important. As you can see, the pitch deck here is a series of, say, 10 to 15 slides at the very, very most, because you're going to be limited in time. You want to be succinct. Creating this pitch deck and spending time on this pitch deck and really being smart about it is going to be your best introduction into the venture capital or the investment world.
I just want to make a quick announcement. I know we're at time right now, but if you can stay on longer to the audience, please do. We are going to still answer any questions that we have really quickly.
Next slide, please. So we talked about the financial slides, and because of time, I'll just kind of run through them. Your business model, revenue projections. You don't have to get into any kind of detail, just top line revenue projections on there. Your funding requirements, how much money you're going to need and when, and how you're going to use those funds. Those are the key points to put on your financial slides. Next slide, please. So the financial projections, there's two types of projections. There's bottom up and top down. Typically in the first year, I would prefer to do a bottom up, but for your pitch deck, you want to do a top down. You start with things like your market size. You identify particular segments that you're going to be addressing. And then you basically extrapolate your revenue growth based on certain growth assumptions. And again, your financial professional will help you work through those and make sure that your assumptions are realistic. Next slide, please. A bottom-up financials is a little bit more detailed. You might start, instead of kind of addressing the market in general, you might have a certain revenue pipeline, specific customers, how much for each customer. So it's a lot more granular your revenue forecast. You're going to calculate spending in a lot more detailed instead of just saying, you know, my marketing spend is going to be X% of sales. You're going to say, here are the marketing programs I'm going to put in. Here are the sales professionals I'm going to hire. Here are the consultants and engineers that I'm going to hire. Kind of a lot more detail from for the forecast. And typically, this bottom up is done for at least your first year, and then years 2 through 5 is done more on a top down basis. Next slide, please. So your funding requirements is going to be guided around your milestones. So don't if your next milestone, if getting to your next milestone requires $5 million, don't try to raise 15 million, because that's going to get you through 5 different milestones. But you know, kind of segment your the raise to the different milestones, and be realistic about your raise strategy, and how you're going to spend to achieve those milestones. So things to consider is, number one, of course, your staffing, whether it's consultants or employees. Number 2 is your operational expenses. You know, what kind of tools are you going to need? You know, what kind of facilities are you going to need? Legal help, and so on. And then the technology related to get to you there. If you're a hardware-focused company, you might have to buy, you know, a lot of engineering type materials, so your capital expenses will be great. If you're a software company, you might have a lot of software tools, database licenses, and so on. So make sure that you have a good grasp of that. And again, your finance consultant or your finance professional working with you will help kind of focus you quite a bit. Next slide, please. I think we rushed through this fairly because there's a lot of meat here, and I'm sure there's a lot of questions that we could address. So that is essentially it. And we have, as Cirque mentioned, we have detailed webinars on each segment of what we've gone over, from convertible notes to financial forecasting. And so on. So we really encourage you to kind of look at some of the other webinars that we've done that cover a lot of the segments that we went over very quickly here.
Yeah, we've got presentations on pitch decks, and like spending an hour, you know, just looking at a pitch deck, and so we certainly encourage you to do that. You know, we apologize. We know we're already over our allotted time, and we know your time is very, very valuable. We hope that you enjoyed this presentation. We certainly enjoyed giving it to you, and we hope to hear from you. I apologize also, I think I mentioned this in the chat, that we don't really have time to do a Q&A, but please reach out to us. You can see our contact information here on this page, and we'll try to get back to you as soon as we can with answers.
Awesome. Thank you so much. That was so great, so very detailed. And for everyone that joined us today, we hope to see you for our next webinar. Thanks again.
Thanks, everyone.